All right, so this will be Finance 304 Module 5, and we're going to focus on the Federal Reserve and what they do. Okay, so the Federal Reserve is the central bank for the United States. And as you see on the slide, a central bank is responsible for determining, implementing, and then controlling the monetary policy of their home country. Right, so we're going to speak about the Fed. This is the central bank for the United States. There's a separate one for the European Union, the Eurozone, right? They have their own reserve. The Bank of England for the United Kingdom act as a central bank there. So it's not the only central bank, but it is the one and only central bank for the United States. Okay, then the Federal Reserve System, we have 12 Federal Reserve banks, right? And they're located in various cities. I'll show you a map on the next slide. So they act as a depository institution within their district, and I'll show you a map of these districts. There's a board of governors that oversees this, but each bank has its own board of directors, right, to manage what's going on within that particular bank. The board of governors themselves are a 7-member board, right? They get appointed by the president and confirmed by the Senate, and they stay there for 14 years. And it's such a long period so that it will go over several presidential elections, and it helps make sure that they're thinking long-term, not worried about short-term returns. Here's a map showing those Federal Reserve districts, and then you can see the particular banks, right, that are the Federal Reserve Bank cities with the circles there. And then also you can see the regions that they are responsible for. They're color coded. And then you'll notice too that some banks will have additional branches available. And it just depends on the types of businesses and everything as to how many they would have and where they need to be. We also need to talk about the Federal Open Market Committee. And so this is the policy-making part of the Federal Reserve System. Okay, so they meet and then discuss what they need to do to both promote employment and price stability, or to fight inflation. And these are two things that are at odds. If we try to drive more and more employment, we tend to have a hotter economy and more inflation. The things that we normally take to fight inflation are things like raising interest rates, which also hurt employment. So they doing one sometimes will hurt the other, and they need to balance this for the United States. Okay, now the Federal Reserve Bank has a lot of jobs they're responsible for, so I'm going to go through each of these. But this first slide is showing you they're going to assist in the conduct of the monetary policy, right? So what they do is they set the discount rate, and then they transact any loans at what's known as the discount window. Now, the Fed at the discount window acts as a lender of last resort. People do not like to go to the window to borrow money. It's often taken as a sign by the market that you're needing this cash. And there was a research paper done not too long ago where they found that banks were willing to pay above the discount window rate, that discount rate, to borrow from other banks. And it was because it was seen as such a stigma that you needed to use that. But in the event that you do need it, the bank will stay open because they do have access to this. But it is seen as like sort of a negative sign. They also operate this supervision and regulatory role, right? So what they do is they look at these member banks that help make up this particular bank, and they can make sure that they're operating appropriately under the current laws. They're also responsible for protecting the community. A lot of work that the Federal Reserve does is doing research on things like how much credit is outstanding and the types of rates that are being paid. And this goes into information that the Congress uses to set new law. They also act as the commercial bank for the U.S. Treasury, so they operate as our bank in that sense. They are responsible for replacing currency as it wears out. So the currency is made at the mint, but it's at the request of the Federal Reserve to replace worn out currency. And they also act as the central clearinghouse for checks. That obviously is very important as we move money from one bank to another, but not just check clearing, but they also do these wire transfer services just to ensure that we have that connectivity. And the last major thing they do is research. Like I said before, they'll do research on various things about our economy, and each Federal Reserve bank will have economists on staff that are doing this type of research and publishing papers on it, so that people have a better understanding of what's going on in the economy. So the Federal Reserve is, bank. So we're going to talk about assets and liabilities in a similar way. So major liability for the Fed would be the currency in circulation, right, and reserves, right? So if you think about, I'm going to show a example with reserves, but the Federal Reserve System, those reserves are money that the banks will set aside by law, right? The Fed will tell them how much to set aside. In the event that there's more reserves available to a bank than are necessary, those are referred to as excess reserves. And those reserves often get lent to firms that are below, right? Instead of going to the discount window to borrow money, banks can make loans to each other using these reserves. Okay, and then as far as the assets of the Federal Reserve, a lot of times it's the U.S. Treasuries, because they're very involved in that market. Also in any currency, gold, and foreign exchange that they're holding. And the next couple of slides are just to show you the balance sheet of the Federal Reserve over time. Right, so this is to show the types of assets that they held. And if you notice, there was a big increase from 2007 to 2008. This is when the Fed took a very active role to get us through the financial crisis, and the Troubled Asset Relief Program, or TARP, happened then as well. You see it grew again between 2013 and 2016, 2010 to 2013, and 2013 to 2016. This is our period of quantitative easing. So you see the Federal Reserve is changing their balance sheet to unwind certain positions, but you still see how large those holdings are. And this is to show you those types of holdings. So like what is I'm sorry, this is the liability side. This is to show you their liability, the other side, not the assets. And then you can see how much is made up of each one. And again, you notice the liabilities grew just as what you saw the assets grow during some of these periods. Okay, so as we said, the Federal Reserve is going to do monetary policy, and they drive that monetary policy through open market operations, through changing the discount rate, and by changing those reserve requirements, right? So those are the three major tools that they have. And each of those will have other impacts within the system, okay? And so what they're doing is indirectly influencing sort of the velocity of money, how much money is flowing through by putting more or less money into the system. Right. And so this would be a way of looking at those three things. So in the right-hand side, upper right, you see the open market operations, right? And so this is where, they're just getting involved in in these types of trades, right? Which either drain reserves or add to reserves, depending on if they're doing repurchases or reverse repos. You also have the discount window loans that we've talked about in the upper left-hand corner, right? That's the other, by adjusting that rate, the Federal Reserve is able to encourage or discourage money coming into or going out of the system. And then finally, those total reserves in the banking system that's in the middle, and you see the trade reserves. So you can imagine they can move that bar up and down to determine how much you have. And then if you have excess reserves, obviously you would try to find banks that need those reserves to borrow them from you. But they can adjust where that bar is to determine if banks need to put more into reserve, or if they have more reserves available and they can go make more loans or what have you. So that's what we're going to focus on now, the open market, and then the discount window, and then the reserve. Excuse me. So yeah, as I said, that those excess reserves, they can trade those with each other by making loans to each other, and that rate is called the federal funds rate, the Fed funds rate. And this is, sort of the safest loans banks make to each other, because they're fully collateralized with the reserves held within the Federal Reserve System. So this is going to be a very low rate that these interbank transactions are occurring at, but they do pay an interest rate to each other, right? So there is a payment that's occurring there. Okay, so jumping into our open market operations, right? So when the Federal Reserve is looking to get into the market, they'll go out and they'll tell their traders, this is what we need to do. I need you to purchase, or I'm going to need you to sell these things. And so by doing that, they're directly influencing how much is available, right? So they can do it with anything. Normally it's with treasuries, right? Doing repurchase agreements or reverse repurchase agreements to change the amount of reserves that's available within that system. This is to show, you see the gray bar was the financial recession associated with the housing crisis in 2008. And you notice how the Fed's assets grew dramatically. That's in that troubled asset relief program, where the Fed took on a lot of these assets so that they could start unwinding them, figuring out what had value still. Excuse me. Okay. Second tool that they have is that discount rate. So this is what they charge on loans to their financial institutions, right? And so this is a tool that is really more about just sending signals, right? And it's because this isn't the best tool to actually drive changes. So it's more about telling people this is what the new rate will be, and then people understand, oh, they're saying the rates need to be higher, need to be lower, and it sort of is used more that way, because there is this stigma about using the discount window, and so firms aren't going to it's not a normal part of the market because of that, right? So but it is a good tool, at least for sending signals. Here's a chart over time showing how various interest rates, and then the discount rate is in that almost like a peach color. And you see how that one's moved, and then other ones moved more or less around it. And it sort of shows how it is a tool, but it's not driving things as much as some others. So yeah, it's not perfect as a tool in that way, but it's one of those things that helps send those signals. Okay, it used to be that window was only available to the depository institutions, but they changed that. And in fact, that came up in the 2008 crisis where they went to manufacturing firms and gave them access to the window just to ensure that capital would be available when some of our credit markets like commercial paper had frozen up a bit. So to keep that flowing, it was used in that way. And the last thing that they can do are modify the reserve requirements. So this is the amount of reserves that you have to have as a depository institution as a percentage of your assets, right? So as you have too many sort of reserves, then you wish to either make loans with it to other financial institutions, or you could make out, more loans into the economy, right? So if they drop the reserve requirements, if they lower those reserve requirements, then I have excess reserves, which means I can go make more loans, right? So it's going to encourage more credit activity in the economy. If they tighten the reserve ratios, then they're going to be more careful about the loans that they give because they're required to keep so much more on reserve. Right. And this also has a direct impact on the money supply because of the multiplier effect. And so these two equations are really just showing how as they change that, it changes the amount of money available in the market because the impact of these loans upon loans upon loans, right? So if I make a loan and then they go and deposit that in another institution, they have additional reserves and they can then make loans, right? So there's always we have to consider the multiplier effect and how it influences the amount of money available. Right. So this kind of shows you the indirectness of it all. It's kind of like a Rube Goldberg machine, right? They try to make their changes. Then they have all these economists that are looking at what's going on. How does the market absorb these changes? How does other government institutions react? What do we see in cross-border activity? And then once we have that and we start seeing what the results are, then we go back and we say, oh, maybe we need to do it some more. Maybe we need to cut back. And so they're constantly monitoring these things because it can take a while for changes to show. And also they're not exact tools, like we were talking, particularly with the discount rate and how difficult that can be. But they try to use these tools in combination for us to hit those targets. And this is just to show you sort of thinking about what they can do, like how they can use those tools to either try to expand the economy or try to contract, right? Because they may have to do either one. Right. And then this is to show what those impacts would have on monetary policy. All right. Now, one issue is that they can only try to go after money supply or interest rates. They can't do both, right? Because one is a function of the other. So if they're trying to affect money supply, then interest rates must be allowed to move. If they're trying to fix an interest rate, then the money supply must be allowed to move. And if you notice there on the bottom, it tells like during different periods, right? There was a particular target, and then it tells you the years that we were using that as a target, right? So those were just different regimes that we had, and we had different impacts on our economy, right? But let's look at that targeting money supply versus interest rates. Right. So if you look at the top graph here, targeting money supply, right? So you see the demand for money, right? And the demand for money goes from the upper left to the lower right. Okay. As there's higher interest rate, there'll be less well, as a demand, it would be higher. And then if we are trying to change our money supply, which you see is like the vertical line there, right? If I'm going to say this is what money supply is, I need to let the interest rates move to wherever it needs to be based on what the demand is for that given supply. Alternatively, if I'm going to target a particular interest rate, that would be like the bottom one, then I'm going to have to let that money supply move to wherever it needs to be to maintain that rate given the amount of demand. Right, but they can't fix both the supply of money and what the interest rate would be because that may not intersect with what our current demand for money is. Right, and supply is just a vertical line because it's just supplied by the Fed. Right, it's not a normal thing where other people may decide, well, I'm going to create some money too, right? You know, with a normal supply curve. This slide is really just giving you a little bit of a rundown about how the Fed has sort of changed policy in time. This the most recent period was really targeting interest rates, making sure things stayed low so that the government would see the economy growing, right? Lower interest rates make it easier to borrow. So this is what you were seeing. I mentioned before the European Central Bank and then the Bank of England. Those are independent banks. So in the case of the Fed, you know, the governors are nominated by the president, then get confirmed by the Senate, and then they stay there for 14 years, right? And so that gives them a level of independence from the political system that you don't find in every central bank, and that's part of why the currencies will be treated differently. Right. So during the financial crisis, these were the types of things that the uh, Fed were involved in, because what they wanted to do was to see the system itself survive. The things like the debt guarantees and the asset repurchases, those were politically difficult at the time, but it was seen as important to get the U.S. Through the crisis. After the crisis, though, Europe continued to struggle with the debt crisis that hit a number of countries, primarily in Southern Europe. As part of this, Greece actually had to or privatize a lot of national items to raise the capital necessary to pay back creditors within the EU, because their situation had gotten so out of control. Then once the EU started to get things back under control, Brexit happened, right? And so this has caused a lot of disruption. And as you can imagine, these central banks again have to work together to figure this out. All right. Well, that concludes Module 5, the discussion of the Federal Reserve System. Good luck with your assignments this week.